Perfect. Well, thank you everybody for being here. Give me a thumbs up. I'm just going to play the audio at first just for a second, and then I want to get a thumbs up and then I'll start it over. I just want to make sure that you can hear this.
Oh my God.
Okay, everybody can hear that? All right. Well, most people, I think, okay, Boyd gave me the thumbs up. So, okay. So this is, I want to start out because I'm going to be talking about how to save money on taxes when you divest of your business, when you sell it, when you get rid of it, when it's time to move on, it's an exit plan. And so we're going to talk about 3 different strategies that people sometimes use. These are not comprehensive. So there are multiple strategies. If you want to know the best strategy for your business, that's where you sit down with me or my team and we can go through that and talk about it. But let me play this video and then we'll dive in.
Oh my gosh.
Where's all your money gone, Daddy?
Taxes. 9, 10, 11. Let me fix my houses.
Bug, it's okay. It's part of the game.
No, it's not.
It
It's not
is.
fun.
It's not fun to what?
It's the worst part of the game.
Oh, it's what?
Taxes.
All right. So I wanted to start out with that because all of us can feel like that kid. That's a life lesson right there. Taxes are the worst part of the game. So how do we avoid them as much as possible? And that's what Pratt and LeFevre really is all about. But it's what I do as well. We have a conglomeration in South Jordan, Utah called Elysium. And Elysium, there, I'm part of the financial and wealth management team. I'm a CFP, a certified financial planner. I'm what's called a CMA, a certified managerial accountant. And I'm also a CPA, a certified public accountant. So we're going to talk about 3 different strategies. Again, I have to point out no part of this presentation represents any financial advice specific to you. Clients sit down with me for personal, for actual advice. So, and then registration within my company, it doesn't imply any level of skill or training. I have to say that even though, take it what you will, I do have a CPA and a CFP. So with that, we'll dive in. The 2, and actually, let me switch display settings. I'm going to swap that. There we go. So the 2 strategies, or the 3 strategies, sorry, that I am going to be talking about are family limited partnerships, or FLPs, self-canceling installment notes, or what we call SCINs, and DAFs, donor advised funds. So getting more out of your business exit and saving on taxes. So real quick, what's an FLP? A family limited partnership. Think of it like a jigsaw puzzle. Grandpa, or maybe, the family, whatever, has a business and they've been running this. Grandma and grandpa have been running this business for years and years, and they've built it up. And now they want to divest of it and they want to pass it on to, and they have a lot of, grandkids and some kids. And some of them, they don't trust with running the business. So some people are going to be only limited partners, meaning they get a piece of the pie, but they're not going to run anything. The ones who have control, they're going to be given general partnerships, or maybe grandma and grandpa keep the general partnership shares so they run the business until they're no longer able or wanting to, or they passed on. And then those general partner shares go on to somebody else who runs it. So maybe you have a nephew who you trust, and then you have another nephew who you don't trust, and one is going to be a general partner, the other will not be. So, but what can be put into an FLP? Let me skip forward real quick, 2 slides. Family limited partnerships are really great because think of it like a bucket or a box, similar to a trust, where you can put in more than just a business. You could put in real estate, you could put in securities, other assets, private equity, and your privately held businesses into this, and then divvy them out. And some people run it, general partners, and some people don't, limited partners, but they still have a percent control. Or sorry, they still have a percent participation in the business. You can gift limited partnership interest, so you can divide it out into enough different blocks, and small enough blocks where you're giving it out and you stay within the $19,000 per year annual gift tax exclusion. That's the limit that you can give away to any one person from an individual and not have to pay any sort of gift tax in 2025, and that goes up every year. There's also a lifetime giving limit that you can only give up to 13.99 million, Would that would be an issue for most of my clients? It's not, but for some people it is. Think about these multi-million and billion-dollar, corporations and whatnot, and that becomes important because then you end up paying quite a bit in taxes if you're over that 13.99. That, by the way, that limit is set to change in 2026 unless the Congress or they get their act together and do something. It's set to sunset, and it'll go back down to 7 million. So it'll effectively go in half, and it'll affect a lot of people if that doesn't get changed. I anticipate that it will be extended with our current leadership. That's who put it in place at the larger amount in the first place. So, but anyway, there are a lot of tax advantages in doing a family limited partnership, because then you can just divvy out and pass off pieces and stay under that amount and avoid a lot of taxes along the way for the transfer of assets. So think of it this way. I've kind of gone through this, but parents or grandparents, have the general partners, and then maybe the children or the grandchildren have the limited partner, 0% control. Limited partnership interest for minors can be held in a family trust, so that's nice. And then think of it this way. So, you transfer, the parents or whoever transfers the family assets into a family limited partnership. So again, not just a business, can be all assets. And then, and also insurance and death proceeds can go to there. And then the gift limited, you can gift out to children pieces of that over time to really save you on money. If you sold a business and you pay the taxes on the sale versus giving out little pieces at a time over time and not paying any taxes whatsoever, there's a big difference there. And that's why family limited partnerships are so great. So we're going to move on for time's sake. There's a lot more to that. But if you'd like to discuss more about it in FLP, if it's right for you, get in touch with me. I'll bring up my contact information after this. Okay, self-canceling installment notes. What's a SCIN? Is what they're called. That's really the name. So a self-canceling installment note, it's a promissory note with a provision that automatically cancels the buyer's obligation to pay if the seller dies before the note's maturity, before it's all been paid back. So think about it this way. If I sell my business to somebody, I'm going to expect that I get paid on that. But if I'm a father and I sell my business to my daughter and she is making me payments because now she's running the business, she's worked in the business her whole life, and she's making me payments, and that's what I live off of. A self-canceling installment note, when I die, will just say, you know what? That note is devoid and defunct, and it's gone, and the business is hers. And why is this important? Well, first of all, it helps to not have an obligation for somebody, if they're paying this off and then they go, okay, if you're not around, I would be the one who would inherit everything anyway. Why have the obligation to continue to pay just to turn around and inherit that? But the real beauty of it, and I'm going to get to that tax break right here, property sold under a self-canceling installment note is removed from the seller's estate for federal estate tax purposes, which means if I go through probate, when I pass away, my whole estate and everything like that, it's not going to be probated at all. For federal income tax purposes, cancellation of payments upon the seller's death, you do have to report. For example, my daughter receives a $2 million business and she only paid me $200,000. It's $1.8 million that the business is valued that I never received payment on. You do have to report that, but instead of paying estate taxes on $1.8 million, which can be up to 40%, that you'd have to be taxed on, that you'd have to pay taxes on, doing long-term capital gains rates, which max at 20%, is much, much better. So a self-canceling installment note can be a really good thing when you're passing on a business, particularly if it's somebody that's related to you, kids, grandkids, spouse. Spouse wouldn't matter because they get an exclusion anyway, but that type of thing. So if you have any questions on that, love to talk further on it. We're going to move to the next one for time. This one is one of my favorites, and I use this strategy all the time for myself and for other people. It's called a DAF, and don't confuse it with daft. Don't add the T. A DAF is actually a very smart thing. It's called a donor advised fund, DAF, DAF. A donor advised fund is a giving account established for future charitable giving. It allows donors to make a charitable contribution, receive an immediate tax deduction, then make charitable grants from that fund over time. So, and I know what you're thinking. You're thinking, hey, if I want to donate to charity, why not just give straight to the charity? Why do I want to give to a DAF first and then give to the charity? So there's a couple of reasons. Number one, I might not know what charities I want to support in the future, and I can put money into a DAF, a DAF is an irrevocable trust. So the moment that I put the money into there, it's gone out of mine, but I still control it. I can't take it back to use it for myself, but I can go ahead and pay other charities, with that money. And so I can invest it, I can have it grow, I can have more money maybe than I put into there eventually and divvy it out. The other thing that I can do is if I'm charitably inclined, and this works really well, especially if people are charitably inclined. In our area, we live in Utah, a lot of people pay tithing. That's just a thing. So I'm going to address that. For example, let's say that I paid $10,000 a year in tithing. Because that $10,000 along with a few other things doesn't get me over the tax standard deduction, which for a married couple right now is about $29,000 a year. Because that doesn't usually get me over, if it's just $10,000 that I'm donating, what if I bunched a bunch of donations in 1 year and I put them all into a DAF? So let's say I donate $50,000 into the DAF, plus maybe some other things. Now I'm over the standard deduction, so it makes sense for me to itemize my deductions. And I have a lot of clients that will itemize 1 year and then the next year do a standard deduction, standard deduction, standard deduction, and then they'll itemize. And you're taking advantage of your charitable giving because you're bunching it all together and getting all of that deduction in 1 year, which makes a lot more sense. And so charitable bunching. I went over this. Front load multiple years worth of charitable contributions into a DAF in a single year. Claim an itemized deduction, capitalizing on the larger charitable contribution. Distribute money to various charities over time. And I don't have to know that when I first do the donation. I can decide that later. I can change it while claiming the standard deduction in subsequent years. So here's an example. I laid out the math here. Without charitable bunching, let's say that somebody donates $15,000, a married couple. And so this was actually, the standard deduction is a little bit different than it is this year just because it goes up every year. So, and this is a year old. So 15,000 plus state and local taxes plus mortgage interest, they can itemize 31,000 minus the standard deduction. Additional deduction is $3,300. Total donations over 5 years, they would make 75,000, 15,000 times 5. Their total tax deduction over 5 years would be 155,000. Well, what if they charitably bunched, like we talked about? So they did all that 75 in 1 year. And sometimes this makes sense. Like if you're going to donate over to like a Roth, do a Roth conversion from an IRA to a Roth, this is getting into the weeds a little bit, that can spike your taxes. Well, doing a DAF can actually offset that. And so we have sometimes clients that will do that in the same year so that we keep their tax rates at the same, okay? So there's a lot of strategy. That's what we do here at Elysium Financial Wealth Management. If you want to talk, we can talk later about your situation. So, but total itemized deductions, 91,000 in this case, minus out the standard deduction, the additional deduction is 63,300 in that year. So it makes a lot of sense. With the standard deduction, the total tax deduction over 5 years now is going to be 201,800. And so you can see here, without charitable bunching, additional tax savings for doing those donations is only 16,500. But if we do charitable bunching, it can be 63,300, more than 3 times the tax savings over 5 years. Well, then you might say, well, what does this have to do with me and divesting of my business, Jeff? Because you told me you're going to share with me 3 strategies: FLPs, SCINs, and now donor advice fund, DAFs. So let's talk about if you gift a private business. Let's say that why donate a business prior to sale? Number one, if you donate a portion of your business or all of it, most people only do a portion, you can avoid the capital gains on that portion of your business and you get a personal tax deduction. So let's compare this out. Let's say a family wants to be charitably active and is selling their debt-free business for $10 million. Their taxes will include 20% for capital gains and then another 7% for state tax, total of 27%. Their financial advisor suggests, what if they're going to donate, let's donate $2 million of their equity into their donor advice fund, their DAF, to help accomplish, their charitable giving, their philanthropic goals. So here's the case. The sale price, if you donate after the sale, which is the wrong way to do it, you sell it for 10, You have a cost basis. We gave them a cost basis of 100. So now they have a taxable amount of 9.9 million. Their taxes on that is going to be 2.6, that 27% of that. So their after-tax equity is 7.3 million. Then they still donated the 2 million after their final equity, 5.3, and now they have 2 million that they can donate, you know, in their DAF or wherever. And so their income tax savings, you know, at 44%. Anyway, look down their final equity and tax savings, 6.2 million. Okay. If you do the donation before you sell it and you donate 2 million of that into the DAF, and you can just declare it, and there's a special form that you submit that says, hey, when I sell this, I'm donating this over. But by donating the 2 million, it takes it out of the taxable amount. So the taxable amount now is 7.9, taxes are 2.1, total tax equity 5.8. You can see that we still have the 2 million, but our final equity plus tax savings ends up being down there at the bottom, $6.7 million. So you essentially saved $540,000, you know, that didn't go to the government, stayed with you, because we did this in the order that made it important. Okay. Family qualifies for immediate tax deduction based on the fair market value of their business. The family eliminates the capital gains taxes on 2 million by transferring it into their DAF before selling it. And then after taxes, save them 540 like we talked about. Family will now have $2 million to give out to social causes that they're most passionate about. And they can grow those amounts. The 2 million actually can grow in the DAF while it's still sitting there before they donate it. Okay. Other things about a DAF. I know that Ron mentioned several of his clients have a private foundation versus a DAF, and they don't have a DAF. Well, private foundation can be a little bit more complicated to set up. There can be, you know, requirements. If you go down distributions, IRS requires that you don't distribute 5% of your assets per year in a private foundation. All contributions are made public. A DAF can sometimes be a better solution because you can donate just as much and you don't have any required distributions. You can wait on it. You can make anonymous contributions. You can be hidden. You don't have to be in the limelight. Low costs, low fees. The one difference that we found, let's say that my neighbor has cancer and that I want to donate to them, unless they're a charitable organization, a 501c3, you can't issue grants to individuals under a DAF. You have to have an eligible 501c3. Private foundation, you can. If it's worth it to set up the private foundation because you have a special circumstance, that's great. But for a lot of people, a DAF makes a lot of sense in that situation. So that is my presentation. I would love to toss it back out and see if there are any questions. I know we flew through a lot of information there. And all I see is pictures of people.
I don't see any comments or questions that I put in that they can put it into the chat. So, but I don't see anything.
Okay.
Okay. So I think it will have Ron come in. Wait a minute. We've got, oh, one person gave you a heart. So you're in good shape. That was Michelle.
Okay.
So,
Thank you
okay,
so much.
Ron, are you ready?
I'm ready. I'm just trying to get my picture on, but it's not showing.
Let's look here.
Keep trying to take. I got it on the no video. I see it. You got it disabled. I see.
There you are.
There we go.
All right, Jeff, I'm going to put you back in with everybody else. So you already did that. Okay.
All right.
Cool. Okay, Ron, go ahead and take it away. And like I said in the chat, if you have any questions anytime, put them in the chat so you don't forget them, like Ron sometimes does. and then we'll ask them at the end. Okay. Thank you.
Well, it's great to be here. I know everybody here. So some of you may not know each other. Michelle, I know quite well. And Glenn, I know quite well. Mifan is from Nigeria. So he is a student right now at Nigeria.
Ron, you're showing your page, your computer page, not your presentation.
Gotcha. Okay. All right. I'm sorry about that.
No, you're still not showing your presentation.
It will. Just be patient.
Okay. Okay.
Okay. All right.
From
So,
beginning. Okay, there you go.
all right. So those who, if you don't know each other in here, I've known Jeff for quite some time. Think the world of him. I listen to him all the time just because he's really sharp. So the things I'm going to tell you are while you're alive, and how to get the business so that you can move it to a forward without probate when you're something happens to you. You know what I'm saying? And I'm sure nothing will happen to you until the Lord gives you the go ahead to leave, right? I don't believe that anybody ever leaves before their time. So can everybody see the presentation now?
We
Great.
do.
All right. So what I'm trying to do is to give you some ideas of what to do, and Jeff has given you some great ideas, and those are things that everybody can use no matter where it happens. But what I want to do is to start planning a little bit ahead of time. I'm concerned about several things. Anyway, this is the organizations that I belong to, my certifications, okay? And this is just a little bit about it, just so you know a little bit about me. Down in the right-hand corner, you'll see my family. We've been married for 46 and a half years and have 9 children and 22 grandchildren. And we've had some good times together. I was in the Marine Corps during Vietnam, and I still haven't gotten any better looking, so we can get out of that picture. Okay, now, when you're building a business, and this is what most of the people do, is they go out and they file with the state. And what I'm going to do today is discuss your business currently and what we suggest for you, and it includes planning for what if. What happens to your business if something happens to you? Right? What happens to your business if you become incapacitated? What happens if you and your spouse pass away? Okay? Those are the things we want to come across. And right now, if you've got a business and you call yourself an LLC or an S corporation, you can't have the same protection. If you are a single owner, the IRS has rules that's called the related party rules. And the idea is that you and your business are related. And if you're going to work together and you're going to do things so that you're not just commingling things, you're just not passing money right now, but whatever way you want to, there's got to be a legal reason. To do a lot of business planning and tax planning now, you've got to remove yourself from being the business. You're going to have to be an individual, okay? And the business is related to you, so it can't treat you any differently than it treats anybody else, right? So right now, the one on the left is the one that you saw, most of it. Don't use DIY places. Don't just go to the state. Don't just go to LegalZoom, because they're not going to do everything for you, right? How do you know that the documents are signed? How do you know that everything's done? They don't require you to do that, okay? And if you don't have the documentation, if you don't follow the format, if you don't follow the formalities, then you're going to have some problems later on if somebody comes after you legally. That's what we want to avoid now, is somebody coming after you and being put into a position where if something happens to you, nothing can happen to the business, okay? So we always say, before you build your log cabin, before you build your mansion, build your log cabin first. Now, this is our concern, right? In business, everybody needs an accountant. You've got to know your numbers. Then you need an attorney. You've got to be able to do it. But the problem is, I often talk to accountants and talk to attorneys and ask them the same question, and we get differing advice. I had the same problem when I bought my first business in 1974. I'd go to an accountant so I could get advice on my finances, and then I'd talk to an attorney, and what he told me was often conflicting with the accountant, and vice versa. Who do you believe, right? Then that's one of the reasons that we asked Jeff and work with Jeff. Jeff is just very good at what he does. I think the world of him. He's very competent, and he can help you do things that we try to do for our clients is also we want to provide his services for everybody so that you can plan, and you need an estate planner. Most people don't have it. And what we suggest to you is that your estate needs to be included in a trust. And we'll talk about that just in a minute. Then you guys are the management. The problem is the managers aren't usually trained in business organization. I am a management accountant. I've been through to school to get a business administration degree. I've studied with the American College of Forensic Examiners. So I am now a forensic auditor. And I do have a PhD, but that's from the School of Hard Knocks. So, you know, they always say that with gain comes pain, guarantee it. Now look at these 4 professionals. You guys are professionals, estate planner, attorney, CPA. You're looking at it from different directions. You're not looking at it from the same angle, right? That's why often people give conflicting advice, because they don't see it from the same direction. Let me get this little bar out of the far way here. Good. Okay. So we want all of these people to start working together. Now, it's not entering here. There we go. One of the things that we want to advise to send and have everybody work with is what we call a corporate strategic advisor, CSA. That person works right directly with the management team. They don't sign on any documents. They don't sign on any bank accounts. They make no decisions. They're there just for an advisory position. But I've told my clients, I'll work with you for a while, but the minute that you quit following my advice, I'm going to quit working with you, because then you're going to get both of us into trouble. And I've been through this for a long enough period of time that I know what most people do that could cause audits and other issues that would get them into serious consequences. Okay, this is what we have, and the idea is Jeff works with his group of people, and that's great. We want to do the same thing, but we're going to bring all of these people into your organization. You don't have to pay for them, but they're going to see it from the same angle. They're not going to look at it from the outside, right? And we assign everybody a CSA, which I just told you about, and a CFO. So a CFO is a chief financial officer, somebody that's going to plan taxes with you every quarter. We're going to meet with them at least once a quarter to plan taxes. And then we also want to make sure your books are done correctly. So if you want to do it on your own, we can help you do that. But if you don't, and you can afford to do it, we want you to use our bookkeeping department so that we know the books are done correctly, the financials are done correctly. And then when you meet with the CFO, we can understand what the taxes are going to look like, because we know the books are correct. Okay? So do not be a hobby business. A hobby business is one owner. I don't care if you call yourself a corporation or if you call yourself an LLC. If you're only one person, the IRS calls you, except for an S corporation, if you're a single member LLC, the IRS calls you a sole proprietor. You're not a business. You're a sole proprietor, okay? Or you're a business owned by you. And the law calls you an alter ego. So we want you to not be a hobby business, be a real business, have a profit motive and a profit incentive, right? Hold meetings, follow the business formality. When you're with the LLC, you are not yourself. You are the LLC, okay? And keep the money separate. Don't pay things all of the time out of your bank account. Don't bring money in from the business and put it into your bank account. Don't take one business's money and put it into another business account unless you've got a legal documented reason. Okay? We want you to operate as the entity and protect the assets. Okay? So, John Rockefeller came up with a tagline, and we use it now. Own nothing, control everything. I always ask people, what is it you want to control? Is there anybody really quickly that tell me what is the most important thing to control? Any ideas? Boyd, is there anybody responding?
Nope, no one's responded.
Okay. The biggest thing to control is money. You want to control your assets, you want to control your house, you want to make sure that it's protected and everything that you've got, and you want to make sure that you're protected. But the biggest thing to control is money. You got to know how to use the money so that you don't have to pay a lot of taxes. So Laura Langemeyer gives seminars all the time, and I've been to a couple of them. She said, if you want to be a millionaire, act like one, right? They have multiple corporations and trusts and entities. They maximize their tax strategies, create liability protection, all of these different optimizations here that are you if you organize yourself correctly. So let's get yourself organized now, which includes a trust. Your trust, though, we don't want it to make money yet. The trust is there for two reasons. Control purposes, because we don't want you to own things, at least publicly visible things. We don't want people to see that you've got assets and start taking things from you. And the other thing that we don't want them to do is to be able to sue you. So we want to have whatever you own be invisible, be anonymous, okay? Here are the different business structures. Which one do you want to use? In our organization, and Jeff and I have talked about this on several occasions, we don't like S corporations. S corporations, in my opinion, from the research that I've done, and I wrote a paper on it one time, it said 23 tax disadvantages for an S corp. But all the rest of these things are taxed differently. Just like Jeff said, there's the different organizations, the FLP, all of those things that can be used, and you can use them on your way. But we want you to be able to do business and protect the investment now and have it available so when something happens, you can pass it on with minimal tax, okay? This is called the related party, right? Any transactions between related parties have to be documented and treated properly, okay? Now, let's talk about trusts. We recommend you have a trust, but a revocable trust is a living trust, right? They all have the same things. They have a grantor. The grantor sets up the trust. They're the ones that dictate things. They're the ones put things in and take things out. They're the ones that assigns the other individuals. They're the ones that name the trustees and the beneficiaries, and they fund the trust. Okay? So what we want to do is have the trustees manage the trust. You guys become the grantors, but because you want to be in control, you also would be the trustees of your own trust. Point is, we don't want you to be vulnerable. So when you're inside the trust, you are the trustees. You're the ones that do the work for the trust. You're the ones that make the decisions. Nobody else does that. You are not yourself. You're not Boyd. You're not Jeff. You're not Ron. You're not yourself. You are a trustee. So you are acting in behalf of the trust, right? And you also dictate who the beneficiaries are going to be. And if you've got children, that's the majority of the thing, okay? So let's talk about irrevocable and revocable. Revocable, the other name is living trust. That's the best one for estate planning. But a living trust doesn't protect your assets. A living trust can be busted. And I've seen several of my clients had that happen before they came to us. Several times I've seen trusts, they get into legal trouble and somebody comes in and starts taking all the assets out of the trust, right? Irrevocable trusts are cannot be breached. They protect assets, but you lose control. Once you set it up and set everything in motion, the trustees take over and you are not the trustees. You are not in control. We like living trusts initially. but the only assets that has is your clothing, your books, your personal items, and we ask you to also put $100 into a single savings account. That's called funding the trust. And you can continually put more things into the trust as a donation to the trust. Okay? Now, we want you to use with the trust a pour over will. A pour over will is a last will and testament. Now, trusts do not have to be probated. They can just continue operating without going to court. All wills have to be probated. But if it's a pour over will, the pour over will basically says, I have things that I'm going to give away, but if I've already given things away, everything I have left over at my death pours like water out of a pitcher into the trust. So the probate is very minimal because there's only one beneficiary. You don't put your children, you don't put your other beneficiaries in the will. You put them only as beneficiaries of the trust. The only beneficiary of the will is the trust itself. That saves a lot of time and it saves a lot of hassle, okay? So what we want you to do is when you're acting like a business, you put yourself inside the business. You are the business. They can't treat you anything differently. You go to a trailer and everybody goes in the trailer is treated exactly the same way. Once you step out, you're out of the trailer, you're yourself. If you tried to do things in the name of the trailer, you're actually living in a pup tent. You have no protection, okay? So we want you to use these things. Not all of them are good for you, but some of them are. The KISS principle, I don't know how many of you have heard this, and so many times I talk to my clients, and they're trying to make things too difficult. Make it easy. The KISS principle is keep it simple, stupid. My wife won't let me tell anybody they're stupid, though, so I always say keep it stupidly simple. Dumb it down. Make it easy to start, easy to manage, and if somebody comes after you, easy to close it down and walk away from it without losing anything. Okay? And you do that from protection, from layering, right? When I'm out fishing, when I'm out on an elk hunt in the middle of the snowstorm, when I'm out skiing, I don't have just one outside cover. That's my brand. I've got a bunch of layers underneath it. And most people, especially when I'm on the ski slopes, don't see anything. Now, what happens if that outside brand gets damaged? What happens if a hole gets punched in it? It's now affecting other things. You go down to a warmer location, you take off that outside brand, you buy something new and you put it on, and then you get out and you start all over again because you lose nothing. Everything underneath there is protected by the brand. You can't maximize your deductions and opportunities with just one structure, but you've got to keep them separated and you control. You get them to work together, okay? Now, just as a real quick information, these are the disadvantages of an S corporation, in my opinion, right? Taxes, management, ownership restrictions, distributions. There are some real disadvantages. And in my opinion, there's only one advantage. And that one advantage is there's no self-employment tax. And that's the one thing you want to try to avoid. Now, here's the biggest problem that I see when you're dealing with business and you want to make sure you're set up in such a way that you're not dealing with strictly passive income. Somebody goes out and buys a piece of real estate and they manage the real estate themselves, and in order to be able to maximize their ability to do things, they have to be considered a professional. They have to spend so many hours in doing this. And we're going to suggest that if you do that, for instance, you got a piece of real estate and somebody else manages it, you've got a property manager, they're going to send you a 1099 at the end of the year, which means that's like receiving a dividend from an investment. That's passive income. Passive income is revenue that's generated that doesn't involve labor or energy or time. Okay, it's just making money while you sleep, right? So what we want to do is to have you take all of your business assets, all of your personal assets, and not make them an investment, but make them a business. The Bradford Tax Institute has an article out there that I go by a lot, and it says, take everything that you're doing and make it a business so that you don't have to worry about so many hours and things, right? So let's say that you have fixed expenses, and this is the expenses everybody has, right? You have all of these things you have to pay, every one of them. Plus, you've also got insurance and taxes. If you didn't own your house, if you didn't own your cars, you wouldn't have these expenses, right? So what we want you to do is to add those into your business as a business. And I don't want you to earn W-2 income. I want you to work as a contractor for your own business. And that way the business can depreciate everything as long as it makes money on an asset. So we want you to pay your personal and business expense and make many of your business expenses personal, legally and ethically. Now, W-2 wages, you make money, right? You earn income, let's say $5,000. You pay your taxes right off the top. You never see it. Then you have to pay that $3,000 worth of expenses, right? After that, you've got some tax left over, and hopefully you got enough to buy groceries and go out to the movies or out to dinner or something, right? What we want you to do is to quit giving the government interest-free money every year, right? And you hope you're going to get a little bit back. In a business, you've got it completely different, right? Because the individual pays their tax first and then pays their expenses with after-tax dollars. A business does it differently, right? We want them to earn the money, but they pay their expenses before they pay their taxes, right? Then they've got that money left over, and that's what they pay the taxes on. And often a business has more expenses than an individual, right? But even with the more expenses, the business pays less tax. So organize everything you have into a business that makes money, and you make money after tax dollars, that you're going to have more money in your pocket. Remember, you control everything. The biggest thing to control is money, right? So let's take those expenses that you're paying right now out of pocket and make them business expenses and give those as deductions so you don't have to earn as much money to pay taxes on. Okay? So let's take it. How does a partnership work? And that's what I want you to do, is I want you to make your business a legitimate partnership. Jeff has given you some partnership ideas, which are absolutely great. Okay? And so what we want them to do is to do partnership formations. And yes, they are simpler than a corporation, but we're going to suggest you use both of them together. Okay? And capital gains is what happens if you sell assets or give assets away after or before you pass on. We want you to create a business that the donations are not taxable. The assets you put into it are not taxable to you. That contribution with the business is not taxable at all. The business doesn't have to pay tax on it. And you're going to create that partnership and donate things tax-free. Okay? So let's talk about expenses. There are two types of expenses in business and in personal life. Okay? The first is cash. So you're going to make cash expenses, right? And you're going to pay expenses. The only legitimate way to take money and get a deduction is an expense. But there's also a second expense. It's called non-cash. Non-cash is taking your assets and your house and your cars and your furniture and depreciating them. You get the same as if you paid tax, but you get to keep the money, okay? So let's take the analogy of your business being a cardboard box. You make money, money goes into the box, and when you pay expenses, money comes out of the box. Corporations are self-contained. Whatever money's left over in the bottom of the box, they pay the tax at the end of the year after they pay their expenses. But sole proprietorships, LLCs, partnerships are pass-through. And a pass-through entity, it says that there's a hole in the bottom of the box. When at the end of the tax year, the hole is the plug out of the hole is pulled, you have to pay the tax as the individual. Okay, so how do we get rid of that? We suggest you take a corporation, a C Corp, and an LLC and get them to work together. Corporations have certain tax advantages and disadvantages, the same way with LLCs. But the LLC's advantages outweigh the disadvantages of the corporation, and the corporation's advantages outweigh the disadvantages of the LLC. We want them to work together, right? We want to end up where there's no cash profit. A zero profit does the owner no good, but it saves tax on the corporation, right? An LLC, a zero profit is passed through to the owner. And so you can either have a profit or a loss. And if the LLC has a loss because of tax planning ahead of time, you can then pass that loss on to your personal tax returns and get a larger return on your money. And the thing that's going to help you do that is have the house and the cars and the furniture to be owned by the LLC. And because it's a business, not an investment, the money coming in is what they call ordinary and material. So you can now take that depreciation and depreciate that money. And so because of that, and because it is renting your house is being rented by the corporation and by you. You are no longer an owner of the house. And the corporation is renting an office in the home, has a contract. And it's also renting the automobiles, has a contract. It's documented. And the corporation and the LLC are following those contracts. Okay? So an asset, a financial asset, can be your house, your cars, your furniture, tools, everything, right? Even if it has a loan on that. If you're going to make it a financial asset, right, we call it a capital asset, it has to earn company money. It has to be used for the company to produce income for the company. That's why we put the house in the LLC, and instead of making it an investment where you have to spend so many hours, you are already the owner of it and manage everything having to do with that LLC. Now the house can be depreciated 100%, not just an office and a home. And the cars and the furniture and the assets, other assets are the same, okay? So what we want to do is to have a contract between the corporation and the LLC, right? Corporations are self-contained and they're pass-through, they pay their own tax. Limited liabilities are pass-through, right? If there is too much money in the corporation, we're going to set the corporation up ahead of time as a fiscal year, which means you can start any time in the middle of the year and then 12 months later. The LLCs are a calendar year. That way their tax seasons are offset. And we can have contracts between the LLC and the corporation to pay each other because of contracted obligations. So if the corporation makes too much money, it receives an invoice from the LLC, and then the corporation pays that invoice. Okay, I went up a little bit too fast. We want to be able to move the money because of contracted obligations, the formalities, keeping the businesses separate and you separate. Okay, so what we're going to suggest here is the next business, the organization we suggest everybody be. And there's a reason for it. We'll discuss that. But we're going to suggest that the public is the one you're going to be working for. but the C corporation is going to be the one that earns the money. That's the publicly visible company. The trust is the only owner, and remember, it's a living trust. It's a revocable trust. So the trust owns no asset, so that if somebody sues the trust or sues the corporation because they're visible, there's nothing in it that they can take. And the idea behind that is if somebody comes after them, in the corporation, we suggest you keep at least $1,000 because that's the threshold for being considered solvent. If you've got at least $1,000 in there, somebody comes after you, pay the $1,000 to them, shut the corporation down. If I can get it to do it, I guess it can't here, right? And get it back in the way. But the LLC owns all of the assets. And the trust also is a minority owner, but the spouse and the husband and the wife and husband own the LLC's majority. So if there's losses or profits, it's passed on to them. And if there are losses in there or profits in there, that's when we're going to use the contract to pay the corporation, right? Then we want you to be able to get paid from the LLC, not the corporation. And you are the owner of that. So you pull it out as a draw. You don't get paid by the corporation. You are the executive officers. If you get paid from the corporation, you are then considered a W-2 employee and have to file it as a W-2 employee. Okay? All right. The idea is now, let me go back here just a bit. The idea is the trust is the owner, and the trust is the owner of the LLC. If something happens to you, that trust now becomes irrevocable. If you got a husband or wife, and either one of you pass on, the trust now becomes irrevocable. It cannot be changed. The trustee can remain where it's at. If both of the husband and wife pass away, then there's going to be a successor trustee. And the idea is have the trust own the companies, both of them. If they sell the business, that money can go into the trust and can be distributed to the beneficiaries. If they sell the LLC, they're going to sell the assets with it. And as Jeff explained, there is a good threshold that they don't have to pay taxes on if they get things from the trust. And that's what we want to do, is to have these assets become owned by the trust if something happens to you. And then they can either keep it or sell it or distribute the assets to the benefit of the beneficiaries. So in closing, let me just give you a real quick story, right? Old farmer. Now I'm from Idaho, so I'm very familiar with this type of a situation. And this old farmer had a farm that had been passed down from generation to generation. Didn't have any posterity of his own. He was going to sell it, so he decided he was going to fix up the farm. So he fixed up the barn, he fixed up the fields, took care of everything. The problem was that there was a dry well. He couldn't take care of that. He didn't know what to do with it, and he had an old donkey on the place. Nobody wanted to buy it because of those two problems. And he couldn't figure out what to do until one day he thought his problem was solved when the donkey fell into the well. He said, great, we'll just take care of everything at one time. So he called all of his friends and family and neighbors in, handed them shovels, and they start throwing dirt into the well. Well, the donkey was stupid, but he was old, but he wasn't stupid. He knew exactly what the farmer was trying to do, and he really put up a fuss, but it didn't last long. The farmer said to himself, this donkey can't be dead already. He looked into the well, and as dirt came into the well, the donkey just shook it off and stepped up. Another shovel full of dirt, the donkey shook it off and just stepped up. Right? 2 hours later, donkey walks out of the well. Moral of the story is, you guys are entrepreneurs. Life and business is going to throw dirt on you. Shake it off and step up. But there is one other story ending as well. The donkey was old, yes, he wasn't stupid, knew exactly what the farmer was trying to do. sought out the farmer, bit him on the behind as hard as he could bite. The bite became infected. The old farmer died. Moral of the story: you make a mistake and try to cover your ass, it's going to come back to bite you in the end. Thanks, Boyd.
Well, thank you everyone for being here. And I'm going to stop the recording now. So thank